we're talking about what the 2025 Tax Act means for your investment strategy. My name is Michael Otesoya, and it's a pleasure to serve as your moderator today. There's been a lot of misinformation, misconception, especially on social media about the new Tax Act. People saying the government wants to be deducting 25% of our income, of our salaries, and the likes of them. But our goal today is very simple. We want to break down what these new provisions means in practical terms and how investors, portfolio managers, 9 to 5 corporate guys like you and I, and institutions can strategically reposition themselves ahead of time. As we know, the 2025 Tax Act has introduced several fiscal changes that will take effect come next year, January 2026. And beyond the major announcement, these reforms would affect many areas, including capital tax gains, investment income limits, withholding tax processes, compliance requirements, and incentive for specific sectors. Today, we have an exceptional panel of experts who would help us to interpret the gray areas, various assumptions, and ultimately guide us on how to make informed decision on this. So before I proceed to introduce our panelists, to our listeners, please, as we proceed, do ensure to drop your questions in the chat box, and once it's time, would respond to them accordingly. So joining us today, we have 5 distinguished panelists, each of them bringing a unique perspective on taxation, regulatory compliance, and investment strategy. In no particular order, we have Seun Oyeretan, who is a tax consultant and a partner with ACTS Professional Services. We also have Dipo Olusola, who is the Chief Financial Officer here at IPO Capital. We have Moshope Agbebi, who is the Financial Controller, and also we have Oluwaseun Lawson, who is a team lead in the Finance Department. All right, so we just dive right away into the discussion. So before we go again, let me remind us, listeners, if you have questions, please don't hesitate to just drop them in the chat box and we'll respond to them accordingly. All right, so we dive right into it. So as I said in the introduction, we've had a lot of misconception, we've had a lot of misinformation on social media and the likes of them. So, Big Boy, if I may ask, what are the major highlights of the 2025 Nigerian tax reforms?
Okay, thank you, Michael, and good afternoon, everyone on the call. To answer your questions, the highlights of the 2025 Act was built on the back of reforms that the government has tried to put in place for taxation of the tax system in Nigeria. And this process, of course, had preceded 2025, where a panel was actually put in place to review taxes in Nigeria and come up with recommendations. And subsequent to that, that was pushed to the National Assembly. And eventually we got approvals for 4 bills that was enacted into law precisely in June 2025. And then these 4 bills were centered around one, tax administration. The first bill was called the Nigerian Tax Administration Act. And what that bill was meant to do, or is meant to do, is to provide more like a legal and operational framework for how tax will be administered in Nigeria. We also introduced things like ensuring that everybody is tax registered, either individual or corporate entity. There was also a bill that was enacted called Nigeria's Revenue Service Act, and that bill was one meant to repeal the existing FIRS Act and also change the name of FIRS. FIRS up until now remains Federal Inland Revenue Services. And so the Nigeria's Revenue Service is going to be the new revenue collecting agency for the federal government. So what that act is going to do is it provides the framework and the responsibilities of the Nigerian Revenue Services in terms of collection of taxes at the federal level, and also giving them some form of enhanced enforcement mandates just to ensure that, there's implementation to some of the amendments that have been done to the various tax law. There's also what we call the Insurance Revenue Board Act, which is more of the harmonization of taxes amongst the tiers of governments. We have the federal, we have the states, we have the local governments, and each arm of governments have some level of taxes that they are meant to take. So this just provides a bit of clear structure on how this should actually work. And one other introduction with the Joint Revenue Board Act is what we call a tax appeal tribunal. So what that is also meant to do is meant to manage disputes. I mean, as a taxpayer, you can actually have disputes with the collecting agencies. And as such, there is an act now that's created what we call a tax ombud, right? That will provide a bit of oversight around when there are disputes with around tax payments between taxpayer and the revenue service. And the last one, which again, I mean, which is where conversations will center around today, is what we call the Nigerian Tax Act. And what the Tax Act has actually tried to do is it has tried to consolidate all of the various fragmented tax structures that we have currently in Nigeria. We have up until now, we have the company income tax, we have the personal income tax, we have value-added tax. I mean, we have different type of taxes, but what the Nigerian Tax Act has tried to do is to consolidate all of this into a single tax act. And on this is where actions are not meant to be taken. And this covers around your personal income as individuals, your responsibilities also as corporate entity regarding the kind of services that you do, investment activities as well. A significant part of this, we'll try and touch on it this morning when the conversation progresses. But by and large, that's like an overview of what the key tax acts has actually introduced in 2025. Thank you, Michael.
All right, thank you, Dipo, for giving us that background information to the 2025 Nigerian tax reforms. All right, so let's talk about investment. Shokwe, what are the key changes that affect investment products? And does the reform make any asset class, the stocks, bond, real estate, crypto, relatively more attractive or less attractive?
Good afternoon, everyone. Thanks, Michael, for that important question. So looking at the tax reforms do not specifically make one asset class more or less important or attractive relative to others. So it simply depends on each investor's unique investment strategy, their risk preferences and investment objectives generally. We look at stocks, for instance. This year, stocks have returned up to 40% year to date. And we are aware that for corporates, if you have equity disposal of above 150 million in value or 10 million in gains, then you'll be subjected to capital gain tax at 30%. And while for individuals, it's going to be subjected to the maximum of 25% under the personal income tax. However, if disposals are not reinvested, if disposals are reinvested within a 12-month period, then you won't be subjected to this capital gain tax. We look at bond, for instance. FGM bonds are withholding tax exempt. However, they may not give you as high in terms of returns compared with equities. State bonds too are withholding tax exempt. Of course, corporate bonds are subjected to withholding tax, and real estate is which is real estate investment trusts. However, capital gain tax applies to when you dispose of these assets, the physical asset, for instance, now when you're invested in it, you look at crypto and digital assets. So just like stocks, as long as the underlying item is for investment, is an investment holdings, then it's the CGT would also apply. just like I had mentioned, where stocks are concerned. So I think it's a case of each individual, each investor's unique investment strategy, and where they think, or where, based on some of this information we have, where the tax laws are concerned, for them to make the right decision as to where they're going to be investing. Thank you.
All right, thank you, Shokwe. So, Dipo, capital gains from shares, bonds, and properties, will they now be taxed compared to old existing law or the new laws?
So first is the existing law is still in force till 31st December 2025, right? But from January 1st, 2026, which is the cooling period that has been provided, is when the new tax is meant to become effective. Now, on the back of some of the things I think Shokwe had said earlier is, yes, we would expect that there will be changes to some of these actions that will be taken on some of the various activities that we may get engaged in as individuals or investors. So, for instance, the capital gains that he had mentioned as well is in the old law that currently is priced at 10% CGT. That's what you're meant to do. But what the new law has tried to do is to move that up to 30%. However, the new law has introduced thresholds of what can be considered before you qualify for, before you know if you are going to be charged capital gains or not. One is if there's reinvestment of that proceeds on the capital gains. If you reinvest that proceeds, so the law has allowed you up to 1 year timeline for you to actually reinvest. If you can reinvest that gains that you have made within 1 year, then you can reinvest it. If you can reinvest that gain, rather, I beg your pardon, within 1 year, then no tax is applicable. But it is only when that gain is not reinvested within 1 year, then that's when that tax becomes applicable. For other instruments, prior to now, the FGN bond had been the only exempt instruments that we have allowed by the law. But the new tax act has introduced or has added state government bonds also as part of instruments that are tax exempt, right? So those are the two only investable assets that are tax exempt. The other type of instruments, commercial papers, treasury bills, they are supposed to be subjected to taxes under the new law. So those are the changes when you compare the old law to the new law. But most important to draw out here is for individuals also, right? I mean, Shokwe also touched on this earlier, is the maximum amount you have, not even for individuals generally, but individuals and corporates. Your sales proceeds in a year, as long as it doesn't cross 150 million, then there's no tax applicable. It is only when it exceeds 150 million, that's when tax is applicable. The other side to it is, even though you don't do up to 150 million in a year, but you sell and you make gains in excess of 10 million, then taxes become applicable on that gain. But again, we would expect that the Revenue Service provides some guidelines, because I mean, some of the questions that people have also asked is, does it mean if I sell my stock today, I mean, and I have gains, or I sell in excess of 150 million, I have to wait for a 1 calendar year before I know if I'm going to pay taxes or not. I mean, since there's a 1 year cooling period. But again, on the back of this law, we expect already that there will be some guidelines that will be provided on how to implement some of these laws as described in the law. But as we speak today, that's what the law has actually stated, and that is what we expect to come in effect from 2026. Thank you.
All right, thank you, Dipo. So, Lawson, let's look at the impact of these reforms. And will it affect both individuals and corporate investors equally, or are the impacts different?
All right, thank you, Michael. Good afternoon, everybody. So the impact of these reforms differs significantly for individuals and for corporates in scale and in focus, right? Like Dipo had mentioned and Shokwe as well, they have talked about the progressive tax rates for individuals, or for capital gains tax rather, right? So now for individuals, they'll be taxed within 0 to 25%, right? But for corporates, it has now been aligned with the company income tax, which will be at 30%. Also for individuals, what this reform targets, or the sector of individuals this reform targets, are middle to high earners, right? So high earners will now start paying more taxes than they would have in current year. That would be going on from 2026. Also, there are some individuals who are sort of protected, at least that they are below the progressive tax band, right? As the webinar goes on, we'll talk about the tax rates and how they apply. So low income earners now, as everyone has heard and seen on social media, those that earn 800,000 and below will be exempted from taxes. However, for corporates, it's a totally different ballgame. Companies are now going to be taxed 30% CGT. I mean, they face higher headline effective rates on gains. They have narrower deductions and reliefs. Also, for foreign investors in Nigeria now, they'll be taxed on permanent establishment or significant economic presence basis. So, I mean, it's totally just different for individual and corporate. In what this reform has tried to do is to ensure that everybody now aligns with paying taxes in the country, but really it benefits more individuals because there's much more flexibility for them. However, for corporates, they face more obligations and higher costs. Thank you.
All right, thank you. So, Lawson, let me ask again, for the corporate entity, could you please just expand more on the impact?
All right, so for corporate entities with turnover or revenue of not more than 100 million and assets below 250 million will be exempted from all forms of taxes. And that is the company income tax, the withholding tax, the VAT. However, it is worthy of note that those who are in excess of that 100 million threshold will be subjected to company income tax, and the rate as it still currently exists and will continue is at 30%, right? Also, other key impacts to take note of for corporates will be that there'll be increased filing responsibilities. I'm sure people have heard of the VAT e-invoicing. Also, there's going to be expanded disclosure in tax returns because companies need to now start disclosing third-party related party transactions. They also need to disclose their asset disposals, their capital gains on these disposals. They also need to ensure that they have detailed schedules and detailed transaction lists for incentives and reliefs that they'll be claimed. Also, there's going to be much more enforcement, penalties, and audit risks for companies because these people are easily reached out to, unlike individuals. Right. So there's also more responsibility for withholding taxes because for companies that do businesses with vendors, with individuals or low scale contractors, right? They also need to ensure that they withhold taxes as well and remit on behalf of these people. But in summary, what corporate entities will face now is just more reporting, more auditing, more disclosure. I mean, digital tracking as well. All their digital assets will not be tracked. I mean, they need to give more information to the tax authority. They also face higher penalties for mistakes, for non-remittance, for not compliance as well. Thank you.
All right, thank you, Lawson, for that explanation. All right, to our tax consultant, Sean, you are the authority in this field. If I may ask, which individuals does this tax law applies to? And are there people who are exempted from personal income tax?
Okay, good afternoon, everyone. Thank you for having me here, Michael. The Nigerian Tax Act applies to a broad spectrum of economic participants, but it includes specific exemptions to protect the low-income earners. Now, who is taxed?
All right, I think our network is okay. Sean, are you still there?
And so the law.
All right.
Okay, can you hear me?
Yeah, we can hear you.
So Okay, so I said, who is taxable? The law applies to any taxable person that is engaged in any trade, business, or economic activities that generate incomes. So it covers both resident and non-resident persons, individual or company. So who is a resident person or a company? A resident company means a Nigerian company. Then how about a resident individual? It means an individual in any year of assessment that is domiciled in Nigeria. You have a permanent place available for domestic use in Nigeria, has a place habitual, has substantial economic and immediate family ties in Nigeria. And then the person has sojourned in Nigeria for a period amounting to an aggregate of not less than 183 days in any 12-month period, in any calendar month period. And this is inclusive of the annual leave or temporary period of absence. For non-residents are subject to tax only on the income and gain derived specifically from Nigeria. So, okay, who are those exempted from PIT? Now, the law exempts low-income earners. Individuals with a total annual, taxable income of 800,000 naira less are fully exempted from personal income tax. So I said taxable income after taking into consideration your rent relief. Also, military and diplomatic personnel, they are also exempted from PIT. These are with the wages and salaries of members of Nigerian Army, Navy, Air Force, Police, they are exempted. Also, you have retirement and terminal benefits such as pensions, gratuities, or any retirement benefit that is granted in line with the Pension Reform Act. These are not taxed. How about compensation for loss of
Thank
employment
you
or
for
personal
that
injury? It's a whole
explanation.
lot.
So if I can understand you, military guys will not be paying tax. So as our aunties, carrying uncles at Ladipo Market and the likes of them, they won't be paying tax. So far, they fall within the range of the low income earners, right?
Yes, please. Yes, they fall in between the range of the low income earners. But if
okay. All right.
if they do not fall within that band, they will pay tax.
Okay. All right. So I would like to stay with you a bit. So let me ask again. Are there any relief that is allowed on my tax as an individual? And in what ways can I better manage my tax?
Okay, so the Nigerian Tax Act introduces and retains significant relief to reduce the tax liability. That means the government is so concerned about us. They feel our pains. So some of these reliefs, we have the rent relief, a new relief, which allows you to deduct 20% of your annual rent, although it's capped at 500,000 naira. There are also statutory deductions. You have pensions, the national health insurance, the NHF, National Housing Fund contribution, your life assurance premium. These are all allowable relief that helps you manage your tax exposure. There's also mortgage interest on an owner-occupied residential house. These are deductible. So you can actually manage your tax exposure. How do you manage your tax exposure as an individual? Please keep proper records of all your transactions. You must keep detailed record. What do I mean by record? Receipts, agreement, third-party documents. Particularly for your rent, you need to collect a rent receipt from your landlord because your HR might request for it. And then strategic planning. Capital gain tax is now progressive up to 25% and it's tied to your income for individuals at income tax rate. So those are all ways you can manage your tax exposures.
Okay, good. I think I would like to ask another question because I was hearing something concerning rent relief and the likes of them. So I've got to see some things online about the rent relief. So now, for rent, does it mean that my rent that I pay to my landlord will be returned back to me, right? And if I pay rent to my landlord, will my landlord be charged? Will he be taxed?
Sorry, Michael, I didn't hear you. I didn't get that.
So I'm talking about the rent relief. I'm saying when you mentioned that I should keep my rent receipt, my HR would ask for it. So I'm saying, does it mean that my rent will be returned to me, right? And if I pay rent to my landlord, will my landlord be taxed too for collecting rent?
So if you pay, the law provides that there is a cap for your rent. The maximum you will grant is 500,000 naira. Right? Even when it exceeds 500,000 naira, what the law will grant you as the rent relief 500,000 in that particular year. So maybe you might take this question again. I'm having slight issues with my network. I wonder if I'm answering your question.
Sorry, Sean, can you hear me? We lost you for some seconds.
Hey now, Michael.
Hello, Sean, can you hear me?
Yeah, I can now.
All right. So, would you want to take the response again? All right. I think our network is back. Would you want to take that question?
Okay, thank you, Michael. So yes, to respond to that question, the rent that you pay to your landlord is not collectible. It's only deductible for you to arrive at your taxable income. So what that means is, if, for example, I'll use a practical example now. If I pay 1 million naira as my rent annually, what the law allows is, what the law allows you to do is, the law allows you to it has capped the maximum you can take at 500,000 or 20%. So what that means is, if 1 million naira is my annual rent, what I can claim as relief is just 200,000, which is 20% of the 1 million. That is the maximum at which I can claim. So it's 20% of it, or 500,000. So if my annual rent is 500,000, for example, 20% of 500, if my rent is 5 million, for example, 20% of 5 million is 1 million. But what the law is saying is the maximum you can claim is actually 500,000. So the law has defined it as what you can claim is a 20% or maximum capped at 500,000. Whichever is lower, that is what you can apply to your taxable income. Now, the bit of the question where you asked that, will your landlord be charged? Absolutely, because that rent is an income to your revenue. And I think Sean talked about it earlier when she was talking about taxable person. As long as you're actually you are performing the service that has been performed is he has provided a facility to be used, and he has actually earned rental income in return. So that income that landlord has actually earned will be taxable in his hand. Thank you.
All right, thank you, Dipo, for that explanation. All right, so to our listeners, I'm sure you are enjoying the discussion. So if you have any questions, please don't forget, drop them in the chat box. Once it's time for our Q&A, we are going to pick them. All right, so Dipo, I would want to dwell with you a bit. So how do I calculate my tax as an individual?
Oh, okay, great.
Dipo, would you want me to take that? If it's
okay, so network stable now.
Yeah, I'm back in. Apologies, guys. So,
all right. So,
Michael, is it okay if I take that?
Oh, sure. Please proceed.
Okay, I would just like to share my screen. So I have a calculation here, which I have actually worked on. Okay. So for the calculation, I don't know, can you see my screen? Am I sharing anything at this point?
Not yet.
Nothing yet. Okay. So I have an Excel calculation, which I actually wanted to share. So that would, instead of just speaking from the head. So can you see my screen now?
Oh yes.
Okay. So in calculating the PIT, tax is calculated using the pay as you earn progressive tax bands on your taxable income. Now the formula is your gross income minus your exempt income. Then you're also going to less all your allowable deductions to arrive at your taxable income. So let's look at, so what I did is on that table, we did a computation based on the current law and then the new law. You know, the new law takes effect from January 2026. So that means up till December, 31st of December 2025, we're still going to be using our PIT 2011 Amendment Act, right? So if you look at, if you're earning 25 million as at today, if you look at your taxes, what you'll be paying is going to be 4.148, right? As at today, using the past PIT 2011 Amendment Act. How about if we look at the Nigerian Tax Act 2025? So just go to column C. We have a gross income of 25 million. Then lens pension. So we used same figures, the same relief. Your pension here is 1.6 million. Then relief allowance. So the relief allowance is the rent. That's the 500,000 you're seeing there. So your taxable income using the new law, your taxable income for someone earning 25 million per annum comes to 22,900,000. While using the PIT 2011 Amendment Act, your taxable income is 18.1 million. And then we're going to apply the bands. So I think we should just focus on the Nigerian Tax Act so we don't get confused, because that's going to take effect from January. So using the tax band, remember we said you first 800,000 naira is at 0%. That's why you have the 0% there. Then the next band is 15%, next band 18%. So for someone that earns 25 million, your tax at the end of the day, using the Nigerian Tax Act, which takes effect from January 2026, what you'll be paying, it will be 4.239, right? That's what you'll be paying as tax. So please note that for the Nigerian Tax Act, from January next year, there's nothing like consolidated relief allowance. That has been repealed. So all you have is just your rent relief, which is your lower of 500,000 naira or 20% of rent. Remember, the lower of 500,000 naira, 20% of rent. The consolidated relief allowance has been abolished. So it's important we take note of that. So basically, what's the key takeaway for us? This means that, remember we said that under the Nigerian Tax Act, tax is progressive. So that means the higher you earn, the higher taxes you pay. How about for low income earners? They pay lower taxes. So the removal of the generous consolidated relief allowance increases the taxable income significantly for someone earning 25 million. So the taxable income of that person would increase from 18.15 million to 22.9 million. So the high income earners will pay higher tax. So that's just basically the takeaway. And then you want to manage your tax exposures. Make effective use of the deductions, the allowable reliefs and deductions. Thank you.
All right, thank you for that clarity. So you've heard it, the more you earn, the more you'll be taxed. So especially for those of you who are looking for jobs that will be paying you 10 million naira per month, you've heard it right there. The more you earn, the more you're going to be taxed. All right, so Sean, we've been hearing about the tax reforms and the likes of them. So for those people who don't even understand how to go about this, how can they register to get their tax ID?
Okay, so under the Nigerian Tax Administration Act, every taxable person is expected to register with the relevant tax authority to obtain a tax ID. So what does tax ID mean? It means your tax identification. And this is for the purpose of compliance with tax obligations. For individuals, you can register with your state internal revenue service where you reside. And then for companies, you register with the Federal Inland Revenue Service. From next year, it becomes Nigerian Revenue Service. So for individuals' tax IDs are typically linked to their name. So for most of individuals, you have NIN. I believe if you are resident in Nigeria at this moment, you should have a NIN, National Identification Number. So you could also check online. You can register or verify through FRS or State Internal Revenue Service portal to confirm if you have a tax ID. And then if not, you can register at your closest either State Internal Revenue Service or if it's company's FIRS. And please note that it is free. You don't have to pay for it. The process of getting a tax ID is free. So for companies, visit the nearest FIRS or State Internal Revenue Service, while individuals, you can go to the Joint Tax Board, their platform, their online platform, to check if you have, and if you don't, you can always visit the nearest State Internal Revenue Office to get one.
All right, thank you. So to our listeners, you've heard it. Getting your tax ID is as simple as ABC. Just walk into the nearest state revenue service in your state of residence, talk to them, and they can assist you on how you can get your tax ID. All right, so what's the difference between FIRS and say LIRS, right? Because we've been seeing that. So what's the difference?
So FIRS means the Federal Inland Revenue Service, right? Remember, we said from January next year, it now becomes the Nigerian Revenue Service. So why SIRS is your State Internal Revenue Service. So the difference, the Nigerian Tax Act establishes I'm going to be using it interchangeably because from January next year, what you'll be having is NRS. So maybe we should just get used to it. So the Nigerian Tax Act established the NRS to replace the Federal Inland Revenue Service, and it's the primary tax collection authority in Nigeria. So typically, the NRS will handle corporate taxes, they will handle your value-added taxes of specific residents, including members of the armed forces, although they're exempted. So they manage that, and also non-residents earning income in Nigeria. So the relevant tax authority will be the Nigerian Revenue Service. How about the State Internal Revenue Service? These bodies continue to exist at the state level for collection, and they are also responsible for the administration of taxes for resident individuals. Yeah. So as
right,
an
so as a
individual,
follow-up
you go to
question,
NRS, your State Internal Revenue Service.
Okay. So as a follow-up question, so if I'm working with a federal government agency or what have you, where do I remit my tax? Is it the state or the federal?
Okay, so if you're working with a government parastatal and you are not a member of the armed forces, you are not a diplomat or member of the Nigerian Foreign Service, you will pay your tax to the State Internal Revenue Service of the place where you reside on the January 1st of every year. So every other person, State Internal Revenue Service, except for members of armed forces, diplomatic, or members of Nigerian Foreign Service. So the Nigerian Revenue Service manages all those tax affairs. Yeah.
All right, thank you so much, Sean. So, Shokwe, let's talk about investment. Will dividend income on mutual funds would they be taxed or subjected to withholding tax?
Yeah, beautiful question, Michael. Thanks for that. So mutual funds are collective investment scheme. They are product under the collective investment scheme registered by the Securities and Exchange Commission. And according to the new tax act, income that are received by unit holders are recognized as dividends and will be taxed in the hands of these unit holders. So, for example, if you have a money market fund investment and come Q1 2026, by the time you are receiving your dividend, it's expected that when you're filing your self-assessment for personal income tax, you're supposed to report that income as part of your income, as an individual, which would then be subjected to the progressive tax rates as mentioned earlier by one of the panelists. So it's not going to be subjected to withholding tax. However, once you receive it, you're supposed to record it, just like we've been echoing, to have proper records. Record it as an income, and while you're filing your self-assessment, then you'd include it as one of your or part of your income for the period, and then it would then be subjected to personal income tax. So that provides the clarity. Thank you.
All right. Oh, thank you, Shokwe. So I know Sean mentioned exemptions and the likes of them. So are there any form of exemption for companies who are into agricultural produce?
So one of the um, goodies where this new tax reforms um, has given is such that there's an expanded income tax exemption list, and agriculture falls, into this list. So it has been explicitly included. So the Act now states that income generated from companies engaged in agricultural businesses, whether crop production, livestock, agriculture, um, forestry, dairy, will now be exempted from income tax. However, for the first 5 years from the commencement of business. So I think for our audience that are into this sector, the agricultural sector, and I mean people that would want to get into this sector, this is a good. 2026 is a good time to really get into it, because what this would also do is to help our country increase its non-oil revenue, that will be generated. When you look at it in aggregate. So it's one of the good things to be noted where the new tax reforms act is concerned. Thanks.
All right, thank you. So that's a good one for those who are into the agricultural produce business. All right, so you've heard it. Once the tax reform is being implemented, from the next 5 years, you are exempted from paying tax. So please do ensure to make good use of this opportunity. All right, so let me come back to you. So who is a tax resident in Nigeria?
Okay, so a tax resident in Nigeria, based on the Nigerian Tax Act. Recall our taxes now, based on the Nigerian Tax Act. So for someone who resides in Nigeria, you're domiciled in Nigeria, you have a permanent place available for your domestic use in Nigeria, you're a tax resident. You have a place or a habitual abode in Nigeria, you are a tax resident. You have substantial economic presence, you are a tax resident. Then you are physically present in Nigeria for a period or amounting to an aggregate of not less than 183 days in any 12-month period, inclusive of your annual leave. You are a tax resident. Then you also serve as a diplomat or diplomatic agent of Nigeria in another country. So all these forms is applicable. It makes you a tax resident of Nigeria if it applies to you.
Oh, okay. All right. So what's the implication for an individual running a business?
So as an individual running a business in Nigeria under the Nigerian Tax Act, as a sole proprietor or business owners, you face stricter compliance but clearer structures. What do I mean? That PIT on profits, your business net profits are aggregated with any other personal income and then taxed at the progressive PIT rate for individuals, and then up to a higher tax band of 25% for high income earners. Then compliance, you are personally responsible for filing your tax returns and remitting taxes because there are penalties for that. Then documentation, the new act requires meticulous record keeping of your income and expenses to justify your tax position. Like I tell people, tax is all about documentation, The taxman will come for audit or dex review. All they will be asking for is document. Please ensure you have third-party documents to back up your expenses, and then you're good to go.
All right. So you heard it. The taxman will be at your door if you don't do what is needed at the right time. All right. So if I may ask, right, because we've heard different things. I heard that they will be deducting the tax directly from our account. How true is this?
How can they can't deduct that directly from your account now? Those are all just well, those are false. And if you're not informed, you'll be deformed. So as individuals, if you're earning taxable income, taxable persons, you're meant to contribute your own share to the quota. You're supposed to file your returns. You're expected to pay your own fair share of taxes. But in the instance where the revenue discovers that maybe you are lying or there's reason to think otherwise, they might come for, they have various ways to follow the money. It could be tax audit, it could be in an investigation. And then the person would be liable to any fine or applicable penalty. So do not evade tax, just comply.
All right. So just comply. All right. So let me ask you this. So what are the key changes to note regarding VAT? Right? Who is exempted? What service is VAT exempt or zero rated? And what are the differences?
Okay, one thing I would first of all want us to establish is that the VAT rate still remains at 7.5%. That has not been changed. For the Nigerian Tax Act, it has introduced important updates to simplify VAT administration and then reduce cost of essential goods. So zero rated, the cost of basic consumption items is reduced. So many items that were initially exempted are now zero rated, like the basic food items, the pharmaceuticals, medical products, all these are now zero rated. What this means is that your VAT input on purchases, you can get a refund on it despite it is zero rated. Also, another key changes is VAT paid on materials used in production can now be recovered as a refund. Input VAT recovery has been expanded. Businesses can now recover VAT paid on both services and capital expenditure. Also, another key change is that non-resident suppliers, including e-commerce and digital service providers, are now required to register for VAT and then remit it to the Nigerian Tax Authority. So there are a lot of changes, but those are just few changes that really comes to my head, And then for businesses such as consulting or manufacturing, VAT refunds on qualifying inputs will now be processed within 30 days on application once you apply for same. Yeah.
All right. So let me ask as a follow-up question as regards this VAT exempt and the likes of them. So recently I went to a restaurant to eat, and when they brought the bill, I was seeing something around consumption tax. Please.
Yeah.
Kindly explain to us what this consumption tax is, and will it be taken off too from next year?
So from next year, there wouldn't be any consumption tax again. All what you have is just going to be your value added tax. In Nigerians, from January, at least I can say from January 2026, hotels are not expected to charge both consumption tax and VAT from 2026. The ongoing national reform, it aims to eliminate multiple taxation. You're paying consumption and you're paying VAT. No, from January 2020, all this has been eliminated, and what we just have is the VAT.
All right, so I can go to any restaurant come next year to go and eat without any fear of being charged anything extra. All right.
Hopefully.
So based on the misconception we've heard on social media and the likes of them, we've heard about the fact that those who are betting will be taxed. If you receive gifts, you'll be taxed. And those who are into crypto will also be taxed. Please, can you give more insights to this?
Once you're a taxable person earning taxable income, yes, you will be taxed. Is winnings from lottery taxable under the Nigerian Tax Act 2025? Yes, based on the provisions of the Nigerian Tax Act, winnings from lottery are taxable. Remember, income tax is imposed on income, profit, or gains of any person. And then Section 4.1 outlined the various types of income chargeable to tax if accruing or derived from Nigeria. This list, among the things listed specifically, prizes, winnings, honoraria, grants, award, laurels. Therefore, winnings derived from lottery are included in the definition of taxable income for the recipients.
All right. So for those of you who are into over 2.5 odd and the likes of them, just note that on your earnings, you are going to be taxed. All right. All right. So Lawson, let me ask, are there new reporting obligations such as record keeping, filing disclosures and the likes that individual investors must comply with?
All right, thank you, Michael. Yes, because what the reform has tried to do is ensure everybody becomes responsible tax residents, right? I know a lot of us would complain about, oh, what are we using our taxes to do? I mean, irrespective of that, we're tax residents in Nigeria and it is compulsory for us to remit our taxes, right? So like Shil has said, yeah, all income that you've earned is taxable. So now what the taxman is saying is you have to ensure that you record all your incomes, right? Incomes that you've earned from employment, that you've earned from your crypto sales, from your property sales, from your equity sales. You have to record everything. And I think one thing everybody needs to take note of is you need to have your tax identification number, right? It is very compulsory because I mean, if you don't have it, how do you now?
All right, Sean, we lost you.
All right, can you hear me?
Okay. Yes, loud and clear.
All right. So for individuals, you can go to your state revenue service or the nearest tax station to you to get your tax identification numbers and register. Also, record keeping, it is very important because tell me, how do you come and say, oh, I have this business and I've done this sales, I've done this, but you have no record. So if they slam you in liability, how do you show that, oh, I have enjoyed this relief as well? Do you get? So for those that want to claim pension, that want to claim rent, you need to show some sort of support document to say, oh, I have enjoyed this and I want to claim it. Also, self-assessment and annual filing is compulsory for individuals, right? You can do this by yourself. You can go on your revenue service website. When you log in, there's a prompt that shows where you can input all your income and state everything there. It gives you the breakdown of what you need to input. Also, you need to ensure that all your income you have to mention it. There's no hiding. Those that are remote workers, if you are so far you're a resident in Nigeria, you are a taxable person in Nigeria, you have to do your self-assessment. And for filing of self-assessment, it is not later than 31st March of the following year, right? Also, you have to be able to show proof of deductions, of those allowable deductions, like she has mentioned, for your mortgage interest, your rent relief, your life insurance. I mean, you have to be able to show all these things. Before the reform, a lot of individuals were getting away with not recording anything, right, without remitting taxes. But now the reform is trying to ensure that everybody now pays tax. Like there's no hiding place. So they won't go to your bank account to remove taxes, but I mean, once they call you for an audit or they try to do a self-assessment for you, right? You have to be able to show all these things. You have to be able to show records of all these dealings and all these transactions that you've done. Thank you.
All right, thank you, Lawson. So, Shokbai, as explained by Lawson on the reporting obligations and the likes, we know come next year, it's no longer going to be business as usual. So, can you tell us, are there any form of penalties or sanctions that we need to be aware of?
Thank you, Michael. So, just to mention that these new tax reforms are not out there to punish any body. However, if you do the right thing, I think you'll be better off. So there are consequences for non-filing for individuals and for corporates. So it ranges from about 100,000 naira for the first month, and then subsequently following month, 50,000 naira with an accrued interest, or with an interest at the central bank rates. All right. Secondly, incorrect or falsified filing would also result into being charged penalties. So it's important, just like Lucy had mentioned, to have proper records. I think one of the critical things about the new tax reforms is that you need to have proper records because the tax net has been widened or broadened. All right. And so you need to be able to prove, to the tax authorities when you're doing your personal assessment, or if it's a corporate tax assessment. All right. There's also the late and non-remittance of withholding tax. Withholding tax are supposed to be remitted on the 21st of the following month. And as such, if that deadline is not met, then there are penalties attached to late or non-remittance. Now, there's a very important one that we all should be aware of. When we engage vendors with no tax IDs, this would incur a 5 million naira penalty. And now you may be wondering why that's huge fine. I think it's part of what the new tax reform is trying to achieve, so that every person into business, be it individual or corporate, as much as possible have their TIN or tax ID. And so if you are doing business with anyone from 2026, if you're going to be doing business with anyone from 2026, then you need to ensure that they have their tax IDs. If not, the tax authorities will come after you with a 5 million penalties now. One of the things that this tax reform also seeks to achieve is the fiscalization system. So this is a system in which businesses would have their operations, synced with the NIRS. This is to aid the e-invoicing and also to ensure that there is efficiency, there's clarity, there's accuracy when tax returns are being filed. So it's important that you, as a business person, you put in place that system come 2026. So there are quite a number of other penalties, ranging from even inaccurate filing or not providing sufficient records. And just to put this in summary, this are some of the very critical ones that you should be aware of. Thank you.
All right, thank you, Shokwe. So, as we prepare for the 2026 implementation of the tax reform, are there practical steps that every investor should start taking now?
Okay, thank you, Michael. All of what we've discussed earlier, there are a few ones that affect investment activities, and I think those are things that we need to take note of as investors. One is, first, you need to be knowledgeable about the law. I think that's very important, because that will be the basis, that should guide the basis of decision making that you will take. There's also the bit where you might also need to really understand what your risk profiles are. I mean, these are basically your liquidity needs. I'm emphasizing that point on the back of some of the sentiments that you've seen around, right? For instance, I mean, like we've also talked about earlier around the CGT, where everybody just assume, oh, if I actually make capital gains, then I'll be charged 30%, right? That might not be the case in all cases, on the back of some of the things that we have said. One, if you don't meet the threshold. Two, if you reinvest that money, I mean, within that same sector, right? Within that same market, all of these are exempted. So all of these have to come to bear in terms of the kind of decisions that you make. And it's also important in the sense that you don't only just want to invest in an instrument just because that instrument is not taxable. So for instance, because an instrument has a tax impact, another one doesn't have a tax impact by default. Because you don't want to pay tax to government, you just gravitate towards the one that doesn't have a tax impact. That might not be an optimal decision, right? When you look at the kind of returns that you can get from a global perspective. So those are kind of things that an investor needs to properly look and dissect to guide whatever decisions that you are making. I think Shokwe mentioned earlier, right, when he was talking about the stock market that has returned up to 40% year to date. There are some stocks that have actually returned in excess of that. I mean, if you look at it. So what that is saying is you might even be better off investing in the stock market than you putting your money in fixed income, right? Where you will get a 1-year treasury bills currently is doing about 16, 17% thereabouts, right? So I think all of these are what investors just need to probably sit down and look at it in terms of what are your risk appetites, what are your liquidity needs, so that you can properly plan and work around how you can manage your investments around the impact of the tax, the adjustment of the tax laws come 2026. You may also need the services of tax advisors or your portfolio managers to also properly guide you, on how to navigate through this process. So that would be my recommendations to every investor on the call. Thank you.
All right, thank you, Dipo, for that clarity. So we move into our Q&A session now, and a lot of questions are already coming in. People are asking so many questions just to get clarity. All right, so Sean, I want to start with you on this. So someone is asking, how will the PIT be calculated for those that earn in FX? Sean, are you there? Okay, Dipo, can you
Sorry,
take that for us?
I'm with
Okay,
you now.
so
Sorry, I forgot I was muted.
all right, no
So
problem.
for those you earn in foreign currency, our reporting currency here is Nigeria, and then I believe we have the CBN exchange rate, right? So my understanding of that question is you're paid in foreign currency. I don't know, Michael. Maybe the person can explain better, but you earn in foreign currency. Reporting currency here is in Nigeria. You can use the CBN rate to convert to Naira, and then you apply the table of rates after taking into consideration all the allowable reliefs and deductions. And please, there's something I wanted to emphasize. Those deductions, it's not as if they're automatic. So I cannot grant myself a relief for pension contribution made if I'm not contributing to that pension. So it's not as if it's automatic, because the taxman would always ask for documents when they come to audit those individual companies. So I don't expect anybody competing the personal income tax to just grant yourself relief for pension, mortgage interest, life insurance, when you are actually not contributing to those reliefs. So please, it's important to clarify that. So you're earning in FX, you could use the CBN rate, convert you to have the Naira equivalent, and then you compute your PIT on it, yeah.
Oh, okay. Thank you so much, Sean. So, Dipo, someone is asking, I'm a public transporter that receives 98% of my turnover as cash. How will I be taxed?
That's an interesting question. So one of first is as a citizen, you have a responsibility to actually pay tax to government, and that's your own contribution to ensure that the government can continue with its social contract to its citizen, right? In as much as yes, there's a lot of reforms that have been introduced on 2026, and some of the things that my colleagues have also said regarding monitoring, implementation, and all of that. Right. It is expected that for people that do a lot of transactions off banking system, that might be a bit of difficulty to track, right? As long as you move monies hand to hand. But what you would expect of people like that, and I think there's also been some conversations around very low income earners, artisans, at the very barest, people that sell by the road and things like that, where there's been conversations around, okay, there may just be a flat rate in terms of what they're expected to charge or what they're expected to pay as taxes, maybe periodically on the months. Very small amounts anyway. But of course, that is not part of the law, but that will be part of the amendments or guidelines or clarity that the revenue service will provide come as we go into 2026. But to answer the man's question directly, we would expect that as you get those cash, you can do some simple arithmetic to know what income that you make of it, right? And you can do your obligation as a citizen, right? To report to government, this is the income that I make, and this is your obligation to government. So that's what I can say. In terms of whether the law will find you, well, it may be a bit difficult, because as long as the transaction doesn't move through the system, it might be difficult to track. But again, I don't think you can run that process, except all the people you will deal with you have to pay them via cash. There will be some bank activities that you will find yourself doing, and those are the areas where the taxman can note and can actually further inquire from you. So I hope that clarifies the question. Thank you.
All right, okay. I think I would want Sean to also share more light on that. But let me ask this question, Sean, so you can just expand it together. So this person is asking, for one who doesn't have a 9 to 5, and how do you get rent relief? Also, with someone who gets side gigs only, what's the best way to go about paying tax? Does he have to have a CAC registered company, or what have you?
Michael, sorry, take the latter part of your question again.
Oh, all right. So he's saying, for one who doesn't have a 9 to 5, how do you get rent relief? Also, with someone who gets side gigs only, what's the best way to go about paying tax? That does having a CAC registered company alone help?
Okay, so as an individual, you don't have a 9 to 5 job, right? But you have other sources of income. So remember, what the law says is taxable persons. And then it defines a person as someone engaged in a trade, business, or economic activity that generates income. So you don't have to, it's not a must you have a 9 to 5 job. Do you understand? In as much as you're a taxable person and you are earning taxable income. So you can actually compute your payee by yourself, or you can get a consultant to do that for you. So it is expected that you pay your own fair share of tax. And then and that's where the self-assessment return comes. Everybody, whether you are self-employed or you have your employer, you're expected to file your returns by March. And that March returns, what it means is that when you're filing your returns in March, that's the March of the subsequent year, you're meant to report your employment income, your business profits, your rent, and all the likes. So that returns you're making in March will cover every other thing that your employer did not cover when they filed their own Form H1 in January. So you don't have to be employed. Whether you're employed or not, you're meant to compute your PIT and then pay the taxes to where the relevant state internal revenue service where you reside on the first day of the year. So you have the tax, you have the tax bands. You can apply that after taking into consideration the reliefs and allowances. So you're not employed, but you stay in a house. Are you the one paying the rent? If you're the one paying the rent, you get a rent relief. The cap is 500,000 naira. So even if you're paying 2 million as your rent, what the law allows you to get is just 500,000 naira. That's the cap.
All right. So I think I have a question as in relation to what you just said now. So the person saying, my question is, how do husband and wife living together claim their rent relief? Will both be entitled to the rent relief of 20% gross or 500,000 naira, and both worked in different companies? Now, the second part is, if both take the house rent receipts to their HR to claim rent relief, would this cause a high tax burden on the part of the landlord? And same for individuals that stay with their parents and work as 9 to 5, or friends sharing the apartment.
That's a lot of questions, 3 in 1. Okay, right. I'll try. I hope I can try and address the question. So when you are paying the rent, I believe whose name is written on the receipt. So if they write Mr., so whoever's name is written on that receipt, that's the person that should get the relief, right? That's the person that will take the receipt to his or her employer. I want to expect that maybe the husband pays the rent or the wife, but whoever pays the rent, that's the person's name that will be on the receipt. And eventually that's the person that should get the relief. And then I want to believe we're all being truthful, we're all being truthful, and we'll be truthful to the government. So why would husband and wife want to claim relief? Let's just all pay our own fair share. Then you stay with your parents, right? You're not paying rent. So, and that's why documentation is key under this Nigerian Tax Act. Remember, I said your HR will be asking for your rent receipt. So if you're staying with your parents, you're not paying any rent, then why do you want to get the rent relief? And then please note that the rent relief is capped at 500,000 naira under the Nigerian Tax Act from January 2026. It is capped at 500,000 naira. Even if you are paying 10 million as your rent, you stay in Banana Island, what the law will give you is just 500,000 naira. I hope I've addressed all the questions.
Yeah,
Michael,
so
you can
there's
help me out
there's
if I
a
missed
there's a
any
part of
out.
it of how about those friends who are staying in a shared apartment?
So friends staying in shared apartments, how do you parent? Whose name is written on the receipt? So you might need to tell your, I don't know, to tell your landlord if he's issuing the receipt. Okay, issue the receipt in the 4 of us names and maybe state the amount each person contributes. I don't know. So that when you take that to your HR, do you understand? Shared apartments. So you might need to tell your landlord to be explicit. The receipt should speak for itself. It should speak to what each person contributes. That's just it.
Oh, okay. All right. So, Shokwe, let me ask you this. So, please clarify, will incorporated trustees like churches, NGOs, mosques, clubs, and associations who do not directly earn income be taxed as well? And if yes, on what parameters?
Yeah, very relevant question. So incorporated trustees are companies that are non-profit or not-for-profit, and not their income are not subjected to the company income tax. If those income are as a result of the primary objective of such not-for-profit organization. So, for instance, when you look at a church, for instance, the offerings, the tithes, the seeds that people give are being utilized, for the primary objective, of running the church. So that's not going to be subjected to tax. But so when we look at NGOs, donations that are being received, grants and the likes, as long as those donations and grants are being used for the primary objective of why the NGO was established, then it's not going to be taxable. Also, when we look at so the NGOs, churches, and so basically, if any of these companies or these NGOs now goes outside the scope of their primary objective. So, for instance, maybe a club, that has a big facility, decides to use that facility as rental for someone, for an external person, then that income is outside the scope of the primary reason for that association or club, or be it a church or a mosque. So you look at the church, for instance, it has a big hall. So someone wants to do a wedding, and when you rent that space out, it becomes an income to you that is going to be taxed by the government, because you have gone outside the scope, primary objective of why that not-profit was established. But as long as all the income you receive directly those the income range of what is supposed to come in to you as an NGO, then it won't be subjected. The NGO will not be subjected to tax. But when you decide to now start doing something extra or running, letting out, maybe some of your instruments or facility to external people, then the income derived from such are supposed to form a part of your accessible or taxable profits as an NGO.
All right. Thank you so much, Shokwe. So, Dipo, let me throw this question at you. Someone said recently I received a mail from the Joint Tax Board informing me of my new TIN, despite my normal TIN being functional. So the question is the issuing of a new TIN part of the administration of the new Tax Act?
Okay, thank you, Michael, for that beautiful question. And I think when I introduced earlier, I talked on that as part of the one of the bills that was introduced. I think that's centered around the Nigerian Tax Administration Act. So one of the key things that this is meant to achieve is the government is trying to create a uniform system of IDs. So, for example, I mean, for some of us who may be familiar with the process, the arrangement of tax IDs are different. What you have with the IRS is different from the way it is with the state internal revenue service. Lagos, for example, the way Lagos number is different from Ogun State's number, I mean, and so like that. What they are trying to do is they want to eliminate the challenges people can face when they're actually transacting, such that you don't need to have multiple IDs, right, across various states that you might find yourself in. Hence why what the government is trying to do is to ensure that one, there's a uniform ID that you will use across for all of the transactions that you would have as an individual. Now, that process is not what we are expected to do in terms of front-end activity. So what do I mean? What the government is trying to do is to do a synchronization, especially for people that already have IDs, right? Either at the federal level or even at the state level. You already have an existing IDs. What the government is trying to do is to do a synchronization across the various states with the federal, where they will regenerate a new ID for everyone, and that can now be used. And one of the ways you're trying to do that is as long as you have an NI, I think Sean mentioned that earlier, right? You have a registered bank account, you're operating a bank account. It is expected that bank account you would have a BVN or a NI. So those are the parameters that they are using to try to drive how to come about with the NI. I think even based on some conversations, maybe the NI might itself be what will translate to the tax ID. I mean, but we'll see how that plays out. So the government has given themselves a window of between 1 to 2 years to have that sorted, because it has to do with a lot of synchronizations, especially with some states, a lot of states that are not digitally there regarding tax activities, unlike maybe Lagos, Ogun State, and maybe FCT IRS Abuja. So those are the things that are working back in. But in terms of us, we need to worry about it. The answer is no. At the moment, what you need to do is if you have a tax ID currently, you can continue to use that. If you don't have, you still have an obligation to register based on what is available now. But when that synchronization is done, we won't be required to do anything. It will just be what government to connect using the various databases, and they have that synchronized accordingly. Thank you.
All right, thank you, Dick Wall. So, Sean, this question is for you. It says, please, what happens to Nigerians working abroad and getting their salary in dollars in Nigeria domiciliary account? Will they be taxed? And please suggest how to manage issues of taxes, and if there's a way to move the accounts out of Nigeria since they don't stay in Nigeria. Hello, Sean, are you there? All right, Dick Wall, let me. Oh, okay.
Yes, I'm here.
Okay,
So
should I take that again?
Right. Yes.
All right, so
Can you hear me,
the
Michael?
question is, all right, so what happens to Nigerians working abroad and getting their salaries in dollars in Nigeria domiciliary account? Will they be taxed? Please suggest how to manage issues of taxes and if there's a way to move the account out of Nigeria since they don't stay in Nigeria.
So for a Nigerian working abroad and then you're receiving your salary in your domiciliary account in Nigeria. Now the salary you're receiving here in Nigeria, if it has been taxed, all you need to show to the government is the evidence of tax you have paid on that earnings. And then they can recompute, but you'll be given a relief for the tax that has already been paid in that foreign country. So Nigeria has some double taxation agreements with some countries in the world. And that makes, what that means is that for income, foreign income that you disclose here in Nigeria, you'll be given relief for whatever taxes you've paid in those foreign countries once you have evidence that you have paid those taxes. So it's not an issue.
All right. So thank you so much. Thank you, John, for that clarity. So we've come to the end of the webinar today. All right. So before we wrap up, to our panelists, do you have your final words before we call it a day? Debo, let's go with you first.
Okay, I mean, just a nutshell of everything we discussed about taxes is not a death sentence, it's an obligation that we have as individuals and corporates. And the only thing we are trying to do with this session is to sensitize us on what we need to do. So we have responsibilities as individuals, as managers of maybe various organizations, that we just have to be sure that we are well positioned. We need to keep records of our activities, and we have to do filings as when due. Like I used to tell people, the taxman is not emotional, right? The taxman only work with facts that are provided. So you need all of this to be able to justify some of the actions that you might have engaged in the course of running your business or managing yourself. So just ensure that you have all of the records to justify your actions and you file your returns during due. I think that would just be my summary on this. Thank you.
All right. So can we have your final word?
Okay, for me, it's going to be for us to build a better Nigeria. We all need to play our part. We all need to understand the tax laws, comply, and then the nation will progress. By understanding and obeying the tax laws, we help strengthen Nigerian tax future. We help make our society more transparent, just, and prosperous. Everyone, individuals, businesses, and organizations play a vital role in nation building. God bless Nigeria.
Yes, we all need to play our own role. All right, Shokwe, any final word from you?
Thanks, Michael. So it's important that we assess our investment portfolios for the people, the investors that are connected. And I mean, you feel free to reach out, to us here at Idle Capital Limited if you would like more information as to how the new tax act affect your investments come 2026. So all the best. Thanks.
All right, thank you. And Lawson, what's the final word from you?
All right. So I'll just say that as the tax environment is changing quickly, right, we can as Nigerians, can as a people, because it is our responsibility. So with proper record keeping, with strategic planning and staying informed, I mean, it'll make it easier. It might look overwhelming, but it'll become easier as time goes on. So there's no need to be afraid. There's no need to fear the tax man. But we just need to ensure compliance, and then as a country and as a people, we can make it work.
All right, thank you so much, our wonderful panelists. Thank you so much. So to our listeners, you've heard it all. They've told us, ensure you prepare yourself. If you don't have a tax ID, ensure to get a tax ID ahead of time and ensure you're compliant with the new tax reforms laws. So to the questions that are not answered, don't worry, we'll send the responses to the unanswered questions to our various mails before the close of business today or later this week. Just look out for your mail. You'll get the responses to the unanswered questions. And of course, as we've seen and we've heard today, the 2025 Tax Act is not just about another policy update. It's a structural shift that will define how individuals and institutions approach investment planning, from capital gains adjustment and to reporting obligations and incentive redesign. And of course, proactive planning remains the smartest strategy for every one of us. And on behalf of the panelists and the organizational team, we want to say a very big thank you to you all for joining us for this webinar. We hope today's insight has been able to help us to know how to navigate the forthcoming implementation of the tax reform next year, January 2026, with clarity and confidence. And it's been a pleasure moderating this session. I want to wish you all a wonderful and productive day ahead. Thank you so much for joining us. Bye-bye.
Bye.